Hello and welcome again to Money Talks. I'm George Pitcher and it's a delight to welcome Edmund Shing, who is a columnist with IBTimes UK, an asset manager with BCS Asset Management, and indeed known as the Idle Investor. Book coming soon, eh Ed?
That's right.
Now Ed, your column this week on IBTimes UK is about investing in small caps. Now smaller companies, I imagine, have greater potential for growth and therefore greater potential for growing your money, but surely they offer greater volatility too. So there's great danger, isn't there, that your investment in a small cap might go down with a small company?
Yes, that's always true with any company, George, but more true with a small cap company because it tends to have fewer products and it tends to be earlier in the company life cycle. So yes, greater risk, but also greater returns potentially as well for the investor.
Yeah, but people who want to be really safe want to be in the big FTSE 100 companies, which aren't going to disappear. You're saying that, however, that a shrewd investor can make a good return out of small caps. Is that right?
Take I think that's right. I mean, in any portfolio, I'm not saying put everything into small caps, but I think there is a good argument to put some of your portfolio into small caps to take that extra risk, but to get that extra return over, let's say, the FTSE 100.
I see. Now, before we go any further, though, can you tell us what a small cap is? It's not necessarily the person down the road who's just opened a tyre fitting centre, is it?
No. If we take the UK stock market, we can say the top 100 companies are the FTSE 100s, they are the large caps. The next 250 are what we call mid caps. And so everything below those 350 companies are then classed as small caps. So that's the segment of the market we're looking at.
And is there a better time of year than another to invest in small caps?
There is indeed, George. There is the famous January effect.
Oh, it's coming up then.
Which
the January sales.
January sales, exactly. Now, January tends to be a very strong point in time for small caps, both in the US, as has been recorded by many academic researchers, and also in the UK, where small caps generally perform over 4%. So they gain over 4% in the month of January, like over the last 40 odd years.
Now, you're a big fan of sort of being a passive investor when it comes to funds, and presumably there are plenty of funds that will take care of you in the small cap market. Presumably you want a fairly shrewd and sharp cookie as a fund manager, though, to look after you when you're investing in what is potentially a more volatile area of investment.
That's right, because there are a lot of duds, as in any market, and those are the ones you want to avoid. You want to pick the stars and avoid the duds. And small caps are one of the few areas where active fund managers, stock pickers, can actively beat the index year after year and have been shown to do so. There are three funds I've mentioned in the article, which are run by Mighton, Henderson, and there's a third one called Strategic Equity Capital. All three of these are investment trusts. They are funds, but listed on the stock exchange, and all of these have very good long-term track records and very well-established small-cap fund managers.
So there you are. Over the festive season, keep an eye on those small caps. They could pay for a Christmas hamper. Thank you very much, Ed. Look forward to seeing you again. And you can read Edmund Shing on IBTimes UK. Goodbye for now.